This webinar is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of De Lisle Partners and do not constitute investment advice. Your capital is at risk, and past performance is not a guide to future performance. The value of an investment, capital from it can go down as well as up. My name is Will Rogers. I am the sales director for the VT De Lisle America Fund. I'm delighted to be joined this morning by journalist Lawrence Gosling and Richard De Lisle, the fund manager of the VT De Lisle America Fund. I will just give a sort of 2 or 3 minute overview of the fund for those who are new or who want a reminder, and then I'll hand over to Lawrence and Richard to get into today's discussion. So Richard is a veteran of US equities with over 40 years of experience. He spent 20 years working in the city, including several years as the managing director of US stockbroking firm Dean Witter, before leaving Dean Witter when they merged with Morgan Stanley in 1997. Richard maintains a wide network of former colleagues and professionals from his time in London, who he speaks to when he manages his fund. So just touching quickly on the investment process and the philosophy of the fund. When the team set up the fund, they wanted to put it in a place that would provide the best tailwinds for long-term outperformance. So looked at the long-term data, and the US is the best performing major market, and small cap outperforms large cap over the long term. There you have the fund. So Richard and his team start off with some very broad exploratory research on macro trends and demographic changes to find the best sort of long-term investable themes. Once a theme is identified, they look in a very deep sort of forensic manner at the balance sheets and the companies. Looking backwards is just as important, and seeing that the company sort of would do what they said they would do. The low valuation measures are sort of key considerations in the investment process, and consequently the fund now has the lowest PE at 6.4 times, lowest price sales, and price to book in the entire IA North America sector. But even more impressively, the low valuations have not impacted too much the quality of the businesses in the portfolio. So for example, the fund average long-term earnings growth puts the fund in the top quartile in the sector, and the average holding in the portfolio has positive 5% net cash on the balance sheet, and the average debt to capital ratio is so strong it lies in the top decile of funds in the sector. So launched in 2010, the fund has 15% annualized returns, and was the single best performing active fund both the IA North America sector and the IA North America smaller company sector in 2021. That's all from me. Please do use the Q&A box at the bottom of your screen. Put questions to Lawrence and Richard, and I'll hand over now. Thanks very much.
Thank you very much, Will. Good morning, welcome everybody. So if you're a familiar participant in these, you kind of know the format. Richard and I will kind of have a chat. Really do welcome questions, as Will said, from anybody as we go through. And if you put them into the Q&A button, I'll ask them on your behalf. And if they're kind of questions that sort of require a more considered answer, and Richard, I think, thankfully, is one of those people who would rather think about an answer than just sort of shoot off the top of his head. And we've had a couple of absolute gem questions over the last sort of couple of years that he's gone back to people on. We'll do that again. But if you've got a sort of more sort of simple, timely question, we can answer that straight away. Richard, let's sort of start with the macro. I mean, Will hate me for saying this, but we almost feel like we're at peak miserabilism or sort of peak negativity as far as the kind of US sort of is concerned. As Will said, you know, you've seen quite a few cycles in your time sort of investing in the market. How do you sort of appraise where we are at the moment? Is it quite as bad as it seems?
Well, yes, Lawrence, and good morning. But we've been at a peak miserableness any way we want to measure it for quite a while. So I think everyone's probably quite bored with all these statistics saying, you know, this is the worst for 50 years and so on. And that's the case both for all types of investors, whether it's retail investors, institutional investors, newsletter writers, every part of the process, everyone's pessimistic, and also out in the real world, consumers are not at all confident. And again, 50-year lows all round, and brokers are competing with each other to make their statistics even more dramatic. You know, some people say, oh, well, it goes back before then. And that's the sort of pessimism that induces everyone to make these analogies with the 1970s, and out come those indices that we had forgotten about for a long time, like the misery index combining inflation and so on. And so the problem with all these is that they can keep on going, and that's what they've been doing all summer. But in answer to your question, yes, there's a great deal of pessimism.
And let's try and break some of this sort of down to start with. I mean, you know, when we were having these conversations a year or so ago, you know, we were talking about the meme stocks, the game stock, the sort of phenomena that was kind of playing out there with kind of, you know, private retail investors during sort of COVID driving certain stocks and parts of the market up. And then we sort of seemed to turn relatively quickly about August, September kind of last year. So the market sort of turned there. Again, how are you viewing the market? And then we'll talk about the economy in a minute or two.
Well, on the market, dealing with these levels of pessimism and it just going on down, looking at the market right here, there's a sufficient discounting of values that we could say the market can turn. There's no basis to say, oh, it goes lower, even though it's doing that every day. To really drive it lower is you need another shoe to drop. I think by analogy, it's like we're in 2008 and there's all this pessimism, not as great as today. And then to drive it lower, you needed an exogenous surprise like Lehman going bankrupt, and then it goes lower again. And we've reached that sort of position where we need another negative surprise to get it significantly lower. And we can see that from the parameters, like when Will kindly says we got the cheap, you know, the fund is so cheap and so on. That's the sort of figure. Those are the sort of figures that say, well, yes, you can start a rally from this point, but that doesn't mean it will come.
And that sort of kind of talk about the sort of broader US economy, it generally feels like it's actually still in pretty good shape. What we would have viewed as the positives a few months ago have not really kind of moved. You know, participation rates in the labour market are still strong, unemployment low. You know, I know interest rates have moved a little bit, but they're still, you know, historically kind of very low. The housing market is kind of holding up. That feels pretty good as a macro backdrop. Yes,
but the perversity is now that given the mindset of the Fed that something has to be done, the stronger the economy is, the more negative it is now perceived, because it's perceived that you have to therefore raise interest rates further to break it. And so the market's managed to get itself into a perversity where it actually dislikes the continued strength in the economy because it's made up its mind that's got to stop before we get through this and can look round the bend to the Fed easing properly.
Now we'll come and talk about the Fed in a minute, and also question that's come in already, a very good question about the dollar and the effect it's sort of got on kind of portfolios. But sort of firstly, I mean, I know one area that you point to, and obviously within the portfolio, you've got a number of, you know, what could be called sort of consumer orientated sort of stocks. There's a nice chart that Will found on Bloomberg recently, which I think we've got up on the screen at the moment, which, I mean, Richard, you know, you would point to a couple of kind of areas here that show there are some sort of positive kind of elements, and they are being reflected in one or two of the stocks that are performing well for you in the portfolio.
Well, yes, this is to make the point that this recession, let's just say, call it, that it's here, it's now, is very different from 2008 when the consumers, everyone lost their money in getting negative home equity. Right now, we've got the most home equity we've ever got. If you look at the Fed figures, 19.7 trillion the US consumer has got in their homes. And that's just been going up and up, partly because of the strong employment, but mainly because of the house price moves. And so this chart shows that the people getting hit is just one component, one quintile there. And these are the non-home owning quintile, and they are suffering because of the effects of inflation. Is inflation at currently 8.6, expected to go to 8.8 tomorrow, is greater than the wages at plus 5.1 on the trailing 12 months. So that difference is biting the wage earners at the bottom, but everyone else is doing well.
And if you then sort of extrapolate data like this to one or two of the positions that you've currently got in the portfolio, how does that kind of feed through? Why does this kind of give you confidence? Some of those stocks that you've been holding for a while, certainly the backdrop as far as this chart is concerned means their prospects are still pretty good.
Well, this has led to some extraordinary surprises in the stock market, whereby Walmart and Target had these crashes, which they haven't seen since the '87 crash. The stocks fell apart on surprisingly bad earnings, whereas at the same time, consumer discretionary expenditure for higher item objects has held up much better. And that's surprised on the upside, and that's just reflected in those charts. So as far as our fund is concerned, we've got stocks which are for more higher discretionary expenditure. So the fundamentals of our companies have come through, and that's where we get the lower PE ratio. I mean, and stocks like Build-A-Bear, where it costs you can walk out of the shop having spent $40 on something that might have cost you $5 down the street, and that's doing well at the same time as food shops are not.
So from that perspective, I mean, again, Build-A-Bear, I think Winnebago, some of the outdoor theme that we've talked about in the last sort of couple of years, are ones that are actually holding up quite well against this kind of backdrop.
They have been going sideways since May, partly because they've never been so cheap, and there's various other parameters which have supported them. Essentially, just the cheapness of the stocks has made them somewhat resistant to going down any further. They've curiously been acting in tandem with the FANGs. In that these are sort of stocks which are also now have been perceived to have come down so much that they can't fall any further. But I think it's a short-term coincidence. But yes, they're showing relative strength from a basis of cheapness.
Okay, lovely. Right, we've got two cracking questions. Let's get straight into those before we have a little chat about the Fed. First one, could earnings downgrades be the negative surprise that you sort of maybe kind of touched on a couple of minutes ago that drive the market lower as analysts' earnings expectations will seem either too high or too optimistic?
Well, yes, analysts have been slow to reduce earnings, and for that reason, one of the many off the scale statistics is the PE ratio of the market as a whole has fallen at a faster rate than we've seen for 50 years and so on. So there's been this big PE reset, and Wall Street is now nervously anticipating second quarter earnings, which are starting next week. So that's a great part of the nervousness. So far, according to that chart we've seen there, we haven't seen the weakness come through, and the Wall Street analysts are all busy now analyzing things like the quit rate, which is this has been this big thing of this cycle, whereby everyone's wanted to leave their jobs after the pandemic, and suddenly the quit rate's falling a bit, which is so people are not so confident that they can just do anything, and this is extrapolated to all sorts of panic about changing behavior. It's quite clear with all the pessimism, we must see even these people that have not been hit yet, they must modify their behavior just on the general pessimism around them. So a certain amount of earnings disappointments is certainly priced in, just because the cheapness we've got at the moment. I mean, I'm not saying that Winnebago is going to be on a price earnings of 4 forever, and I'm not saying that they're going to maintain these earnings forever, but they don't have to be cheap. So yes, there will be earnings downgrades. The problem with that is that earnings downgrades really come after the bottom of the market. They're sort of almost a lagging indicator. So yes, they have to come as the economy slows.
And just for people who are not too familiar with the fund, Richard, I mean, quite a few of the positions that you hold are covered by, you know, literally one analyst or a very small handful of analysts. Anyway, so the kind of earnings, analyst earnings expectations, commentary on, you know, the large, very popular stocks is not so much of an issue at parts of the market that you're looking at. Would I be right in saying that?
It's not so much of an issue, but I mean, what we're really looking at is when a company disappoints, to what extent it reacts to that. So we're at the bottom of the market, the company disappoints, the stock doesn't go down. That's what we're really looking for, even though the earnings might be well up there. I mean, if you look at where analysts are expecting things to be, you'd think the stock market has to fly. But our stocks will not jump around on earnings disappointments, no, because there's no one following them.
But I mean, that sort of plays to the point about the sort of volatility of the fund, which is, again, I think is kind of lower than many of your sort of peers in the IA sort of sector. Another question, currencies are always kind of important. So the question is, the weakness of sterling may have cushioned the performance of the fund recently. I think that's an observation as opposed to a question. What are your views on the weakness of sterling, or indeed the strength of the dollar, depending on which way you want to look at it, and the impact that they may have on the funds moving forward? And as you pointed out just before we came on the call, actually, dollar euro is at sort of parity, which is pretty unusual. Might explain the number of North American tourists in London at the moment. But just generally on the sort of strength of the dollar or the weakness of sterling, depending on which way you are and you want to look at it.
Okay, well, if you go back to the modern world, which is the Louvre Accord in 1985, and we look at it, we look, you know, back over those 40 years, we see that on sterling dollar, it's only been below 120, less than 3% of the time. So now here we are below 120. You know that we're at an extreme level on that relationship. You can look back to the pandemic low, that's around 115. It's very difficult to push it below there. Once you get below 115, it's very extreme. We are always, all American funds which are unhedged are dampeners. So for instance, in the 2008 big fall, we went down 30% in sterling terms against an index losing 50% because exactly the same phenomenon. And then sterling bottomed at 110, and it's always the rush to safety in the dollar, which is what's going on at the moment. Ironic, really, that just a few months ago, people were speculating as to when inflation came, what would be the store of value? Would it be Bitcoin? Would it be gold? And it turned out to be the dollar. Not predicted, but it's absolutely what you would expect now, as the Fed is providing the highest interest rates and people want to hide in anything that retains value. So the dollar here at, if you look at the dollar index, that's broken out to a multi-decade high, and that is a constraint on the Fed here. So the more you see these records being made on currencies, the more you can have the confidence that you're very near a turning point, because we've seen these over 40 years, they are bounded, these currencies, by you know, even in extreme. So you know, funny things happen as you go to new levels, and nobody really wants that. I mean, consider that indebted poor countries with their debts in dollars because they don't have the ability to borrow in their local currencies also facing, food shortages, high fuel costs. I don't think it's a very good look for America to sort of bankrupt, bankrupt poorer countries in this environment, but that's what will happen. And so that's something they have to be mindful of. All this hawkish talk, we've got to raise the basis rate, and we've really got to do all that, has the effect of just pushing the dollar higher and higher, and that's not what anyone really wants.
Okay, now before we get on to sort of two other questions, one which is kind of really succinct, I think, and sort of captures maybe what people are thinking. We've got this nice chart about some of the sort of Fed comments that that kind of Will discovered from an absolute return manager called Trium sort of Capital. But my kind of broad question to you, kind of Richard, is kind of what part do you think the Fed is playing in this sort of general kind of perception that the US is, is not in a great place at the moment?
Well, the Fed, as we all know, got off to a slow start, and again, this is where all these analogies come back with the 1970s. Just like in the 1970s, the Fed got off with to a slow start, and this is a bit of a comedy slide, really, because it shows you that, well, wherever we were, the Fed describes it, and then something different happens. So you can see it's all transitory, and it goes up, and it keeps on confounding them until finally they say, well, it's elevated, and then it has its first down month. So the point of the slide being that it doesn't inspire confidence, and the one thing they need to have is confidence, and so that's why there's a pendulum-like effect going on that they've created by being slow to start. That starts the pendulum, then they have to catch up. Now the pendulum is going to swing to too much hawkishness as they're trying to regain credibility, and they're talking this hawkish stance, which is pushing the dollar too high, which is pushing the pessimism too much, and that's for the purpose of convincing people that they are serious about inflation, to stop everyone just unionizing because they feel left out, to try and control that. But the problem with doing that is that they will then overdo it, because the pendulum, they cannot still the pendulum in the middle, because having been slow off the mark, they've set it going. And that's, again, like the 1970s was, this swinging pendulum. There was plenty of recessions back then, and plenty of times when interest rates were cut a lot, only to go back up again. And it seems inconceivable that at this time, they would just continue to be super hawkish to wreck the economy, when a lot of the inflation is coming from the supply side, and that can only really be cured by inducing a worldwide recession, which seems a little excessive.
Okay, right. Let's get stuck into these sort of questions. Nice succinct one. Will the US market bottom before we get the worst of the economic news? Go on, I'll give you a yes or no on that one.
Yes. It will. It always does. Look at the last time, 2009 recession, the market bottomed in March. With the analogy with the 1970s, 1975 recession, US market bottoms in October 74, UK market bottoms in January 75. They always bottom first. That's the same thing with the earnings changes. That's the problem.
Lovely. Okay, another I think short question. Back onto the dollar. What is the catalyst for it to weaken, and do you have a hedged share class for the fund?
The catalyst for it to weaken is the Fed stopping being so hawkish. For instance, if the inflation, if the CPI figure tomorrow comes in at less than 8.8, the dollar will weaken, because it will be perceived that the Fed doesn't have to keep being quite so hawkish because inflation is already coming down. So that sort of thing will be a catalyst for it to weaken, but it may be a short-term catalyst. We don't have a hedged class, so we are effectively a dollar investment. Okay,
and sorry, Richard, just quickly, I mean, do you get the sense that sort of with the Fed under Jay Powell that they're maybe getting a little bit more into their stride? In terms of, it's been a different cycle from previous sort of Fed chair people. do you think they're beginning to get to the pace of the sort of the debate, as it were?
I think that they don't want to be compared with Arthur Burns in the 1970s, and they know who's praised in the past, so they're trying to get the credibility. I don't think they're getting the respect. I think they've got enormous political problems going into the 2024 election. So no, I'm not really sure about that.
Okay. Good question, sort of here, back on the valuations to the point that Will was making out the outside. So our delegate says, I'm intrigued by the low valuations of the companies. It looks almost too good to be true. So Morningstar is showing the price to free cash flow as being kind of very low compared to very good compared to the rest of the North American smaller companies sort of sector. This is significantly out of kilter with other valuation sort of metrics that favour your fund. Can you talk us through the aggregate cash flow of your portfolio companies?
Look, without getting too much into cash flow, yes, the cash flow numbers are very favourable. That's because we've got some primary producers. You can buy energy stocks here on 3 times cash flow, 4 times cash flow for less indebted ones. So we can get those numbers really low. Let's not get too much into that because 24% is in financials, so that's a bit more difficult. But the reason all this impossible to believe is going on is because it seems a paradox. It's very cheap, but it's good quality. You have to consider the third factor, which is duration, the duration which this may be maintained. So for primary producers, you've got peak commodity prices, and that's the duration that you get the earnings. And again, we're talking about going into recession. We're talking about the low PEs on some consumer stocks, and again the question remains how long they can continue to do that. So ours fund, not consciously, but it has become a shorter duration fund, and that's more favored now in these uncertain times. Long duration is essentially stocks which are based on a long way away, technology stocks that don't have any earnings yet, or technology stocks which are on a high PE. That's long duration. You have to see a long time in the future. But ours are short duration, and that's how we do it.
And I think when we chatted last week, you were sort of pointing out that kind of Warren Buffett, that we all quite rightly hold up as a sort of good kind of bellwether to where there's opportunities, has been buying energy stocks quite a lot this year. And again, that's a sort of shorter duration play, isn't it? Really, based on where we are.
Well, he's buying Occidental just on the same thing we just discussed, this cash flow. That's how quickly the money comes back, and Occidental's a more indebted company, so he's getting it on the lower, more towards 3 times cash flow, and that's exactly what he wants. It's a cheapness argument which always appeals to him. And yes, you're right, Lawrence, it's a short duration.
Yeah. Okay, lovely. More questions. We've really got them coming in today, so thank you very much to the audience. I'm going to rattle through as many of these as we can. So another sort of short punchy one. Richard, do you think markets can bottom before the Fed pivots?
No. The
Okay.
Fed is very important here. Mm-hmm. But the Fed is going to be led by the data, and this Fed has actually been quoting the data more than any other Fed. So that's led Wall Street to get super excited and look at the data that the Fed's looking at to try and get ahead of it. So it's a data driven, and so that makes the data very important.
And just on the Fed, when Trump was president, Richard, did you feel that the Fed was in any way influenced by his kind of vocal sort of comments about the importance of the Fed and etc.? I mean, he seemed to be more than previous administrations politicizing the sort of Fed. do you feel maybe the Fed is trying to be less political, less influenced by what the president says? I mean, clearly Biden's a different type of president from Trump,
or indeed Nixon,
or indeed
who did influence the Fed. But with Trump, it was easy because Trump. I mean, all presidents want lower interest rates. Presidents are short duration too, and interest rates were going lower when Trump was in power. Nothing to do with Trump. It was just the cycle. So they were aligned. They both wanted the same thing. They did. Trump complained, but he had no basis to complain because interest rates were going his way.
Mm-hmm. Okay. Very interesting kind of longer term sort of question here. Our delegate would love to hear your opinion on the Chinese yuan. Does it pose a genuine threat to the kind of US dollar, sort of, potentially challenging the dollar's sort of global dominance, so the currency of reserve, as we kind of normally refer to it? So what do you think about that? It's a sort of, that is definitely a longer duration question.
Well, rumours of the death of the dollar have been much exaggerated over the years, and it still retains its more than 50% of currency transactions worldwide. And the rate at which that percentage declines is extremely slow. So I agree with you, Lawrence, it's certainly a longer duration question. I don't see any sign of that at the moment. Indeed, when the dollar's strong, surely that reinforces the dollar as the store of value in the world, which is what the purpose of using that as a currency is. As a reserve currency, you want a decent store of value, which is what, once again, the dollar has surprised people and is turning out to be. So I would continue to go with the dollar. Okay,
and let's, because we've had sort of quite a sobering conversation. I think it's the kind of nature of where we sort of are with kind of markets. Just quick question on the politics. Where do you see sort of Joe Biden at the moment? He sort of doesn't seem, again, to be as kind of important as perhaps he did at the beginning of his administration. Again, a couple of years ago, we were talking about the infrastructure plans and how that might be a positive. Climate change, ESG, all that kind of stuff. I mean, I hesitate to call him a lame duck president, but he doesn't seem to be as influential as he might have been a couple of years ago.
I totally agree. Did you see the poll in the Times today where was it three quarters of people don't want him to run, and majority of Democrats don't want him to run? He's got one positive going for him, which is he polls better than Trump if Trump were to announce his candidacy, but everything else suggests that it's very difficult for him to run again.
Okay, now let's have a look. Oh, another question's come in. Yeah, okay, so while your fund looks cheap, it's hard to argue the broader US market is cheap and is pricing in a recession. Therefore, you'll surely follow any large cap sell-off initially. Is that right?
Well, we held out for a while this year, but from June the 8th, everything went down, and so that is right. Yes, it is right that we're at a stage where everything just gets where everything is vulnerable, because you can make this presumption that, well, on a worldwide recession, you can presume what you like about where earnings are going. So yes, that is right at this stage, which is not a stage that goes on forever.
So I guess the sort of turning that kind of question on its head, your fund, your part of the market, the sort of small and mid cap, micro cap, kind of looks cheap. So now's a good entry point if I'm not invested.
Yes, I mean we're cheap, and yet everything is vulnerable at the moment. But the point is, you need to be positioned for a turn, because when things turn, they can turn quickly, and it could be a catalyst of data coming in that's better than expected, gets things going, because the sentiment where it is, any positivity coming in gets things moving.
And what, you know, other than one or two of the things we looked at, obviously the income levels by quintile earlier in the discussion, what are the other areas that kind of, you know, that you feel sort of positive about, actually? I mean, we've talked a bit sort of negatively, a bit almost pessimistically so far today, but I know from talking to you quite a lot recently, there are areas where you're still positive. You've got this strong position in the community banks that you've kind of held. I know you've trimmed it at various sort of points, but it's still 24%, I think, of the sort of portfolio. So again, that must be an area that you remain positive about.
Again, the community banks are selling at levels that we last saw at the bottom of the market of the great financial crash, and yet the conditions are not going to be anything like that on this turn. So that makes me feel that they've over discounted how bad this can possibly get. So yes, I'm positive on a valuation basis, and I'm positive that there's this extreme pessimism out there, but the things are really not that bad. I mean, it might be shocking to Americans to have 8.6% inflation because they're not really used to it. Their inflation peaks don't go much beyond that, but it's not that much of a disaster when you look at all the macro factors, like where the wage increases are and just the general dynamics of the American economy. The pessimism is built on itself with just, you know, as you discuss, how the politics seems such a mess, how the world seems such a mess, but it's not that bad and the prices are cheap.
Okay. Do small caps typically bottom before large cap? We're being asked, you're being asked.
That's a difficult one. That can vary, but it's typically around about the same time, typically. Sometimes they can show a bit of relative strength going into the bottom, but sometimes not. Okay.
So that's a more difficult answer to give it sort of unequivocally. Other question: what carries greater risk to the market from here? Stronger inflation for longer, or weaker numbers, sort of including a sort of a sharp downturn recession? What do you think?
They're sort of part of the same thing, really, but sharper inflation is bad for the general market as a whole, because it's going to keep taking that PE ratio down, and there will be the presumption that you need to have the recession the sharper recession in order to deal with it. So the answer in the first place is higher inflation is deadly, because it means you get a bigger recession as they have to become more determined to deal with it.
Okay, interesting. Now, I know we're kind of getting to our last sort of 5 or 6 sort of minutes. Again, we've got sort of one more chart, which is kind of around the sort of small cap premium, which again, I think, you know, kind of Richard, you can talk us sort of through this. So some of the kind of historical opportunity, you know, that you think is kind of out there from sort of small cap that you know, might be kind of a useful sort of backdrop for people to kind of see, and given sort of the kind of pessimism we've talked about.
Yeah, well, one of the things we know about small caps is that they beat the market, and the data really starts in 1926. So that's when good data starts. So there you see 2 lines showing that small caps do better over this 96-year period by 1.5%. But how do they do that? They do it in explosive bursts coming off recession lows. So if we could just look at the middle bars there, we're off the 1975 market low there. Small caps explode, and they particularly like an inflationary background. Their best periods of performance are where you get a recession low with inflation in the system. And so I'm saying that this is consistent with our fund being cheap. If we get a turn here with an inflationary background, it really is perfect conditions. That middle bar over the 6 years off the low they went up, as you can see, 32% a year. What that actually means, if you take a 32.3% increase over 6 years, that means your portfolio of small caps has gone up 5.4 times, and that's against 2 times for the large caps growing at 12.1%. Now, I'm not forecasting that that's going to happen, but I am saying that you can get this explosion in small caps. And if you take out those numbers for the 6 years there, you lose almost all your small cap advantage over the 100-year period. So you've got to catch these explosive bursts. Otherwise, you can just be languishing away for long periods of time. So in the more deflationary era of the early part of this century, small caps were worse. So we're in a good asset class, but you've got to be there at the right time.
So this is back to your sort of point a couple of minutes ago about, you would argue it's kind of worth investors remaining, having or consistently having a holding to this, your part of the market, and obviously ideally your fund for when this kind of, when this switch back, when this positive flip back sort of comes.
Yes, because the conditions are in place for the small caps to have a move. There is inflation, and we're going to get through this recession, and at that point we should be well, because small caps are price takers, they're not price makers. Therefore, they like inflation, so they can just mark their prices up.
Lovely. Now we've got another question. We'll squeeze this in before I'll sort of hand over to Will to wrap things up. Does the potential for further interest rate hikes pose a greater threat to the fund's holdings? Because obviously the cost of borrowing would sort of grow up. So a more broad question, sort of how sensitive is the fund's elements of the portfolio to higher interest rates from here?
Well, our companies have a strong capital position, so they're not going to suffer too much from their debts. Borrowing is costing them more, but we are correlating, as with these small caps, with if inflation is stronger, we're doing better because of our weighting in primary producers, if it's the commodities which are driving those numbers. But on interest rates, we are correlating this year. When bonds go down, we outperform, so it's the other way.
And just with community banks, I think our audience will kind of know traditionally banks perform better in a rising interest rate sort of cycle because of the kind of margin opportunity. Does that feed through directly to the community banks as well that you hold?
Well, the community banks lend longer than the other classes of bank, but yes, higher interest rates are better for them in general, although like all banks, they like a bit of a slope on the yield curve, and the yield curve is flat at the moment.
Okay, lovely. One more question that came in, I'll squeeze it in. Are you finding companies to buy now that have historically been good, that are good, but historically have been too expensive for you?
I'm not, no. Okay. I'm not, because there's so many very cheap stocks that I'm not of a mind to say this more expensive stock is now at a level, but I fully understand the question. And I was in a discussion with this about how quality stocks like Illinois Tool Works are coming down to a multiple that has traditionally been an attractive entry point, even though it's at a premium to the market. I mean, that is happening out there for... Yeah.
Okay. Just sort of sum it up though. So Richard, so at this point, early in the summer or mid through the summer, kind of what do you see as the opportunity for your part of the market and the fund?
Well, we're really in the waiting room to get some clarity on I still feel that when the recession is announced, then things go better, because then people can start to look forward. And at the moment, we're just waiting for some catalyst to get things going positively.
I'm tempted to respond with that sounds reminiscent of Grace Jones's "The Revolution Will Not Be Televised." So the recession will not be formally announced. We may already be in it.
Well, certainly it looks like the second quarter of negative GNP growth is in the bag. So yeah, that's true.
Lovely. No, so our colleague will shoot us for finishing on a slightly sort of somber note. But ladies and gentlemen, thank you very much for your questions today. Really superb questions, really kind of engaging. I hope Richard had enough time to answer them. Will, I'll hand over to you to wrap up for today.
Lawrence, Richard, thank you very much. I think that was very informative. Just the last couple of things for me. The fund is available on all major platforms. Just one that is escaping us at the moment, Fidelity Funds Network. If you have a rep with Fidelity, just drop them a quick email or anything like that. Would really help us out. Richard has some good availability for Zoom meetings throughout the second half of July. Any further questions that we didn't get a chance to touch on, just drop your LGBR Capital rep an email. But yeah, look, thanks everyone for listening in, and Lawrence and Richard, hope you all have a wonderful day.